Hey there, Brad Casser from GreatOptionTradingStrategies.com. Got another installment in the weekly recap series I recently started, where the idea is to look at current and recent real-world trades to see what they have to teach us or reinforce in us. Now, I'm not going to be able to post one of these every single week. It takes me several hours to put together even a 10-minute video. But when I do complete one, at least for now, I'm planning on posting them on Sunday mornings. So I mentioned this maybe 2 or 3 videos back, but today I want to take a quick look at a Palantir put selling trade we closed not too long ago inside the Leverage Investing Club. Because I made a move during that little campaign that I rarely make, which is to roll my short put position up to a higher strike rather than leave it at a lower strike where there was a much greater chance of it expiring worthless. Now, that may not be the most earth-shattering adjustment, but it really is kind of important to have a well-thought-out view on the maneuver, at least in general. Is that something you should consider doing with your own trades, or is it something you want to avoid? So I think it would be helpful to share my reasoning for the move, look at how everything played out with the real-world trade, and then consider the pros and cons of making this move in general. And I'm very curious what you would have done had you been in my situation. Let me know in the comments. Now, I know I often compare our approach inside the Leverage Investing Club to that of an option-selling insurance company from hell, where we sell lots of premium and then avoid like the plague ever paying out a claim or booking a loss on a trade, which, because of the flexible and forgiving nature of short options and the effectiveness of our trade repair process, we really don't have to. But really, it often feels like a game too. A strategy game that I've compared to a combination of poker, chess, and your favorite board game from the 1970s. All right, let's jump in. So back on November 4th, 2025, with Palantir trading at $191.51 a share, we entered a November 7th, 2025, $175 short put position and collected 79 cents a contract in premium. Now, here is the rationale for the trade. Palantir had reported earnings the night before, beat estimates and raised guidance, but the stock still sold off the following morning, November 4th. But the stock was well off its earlier session lows and bounced nicely off the 20-day exponential moving average. Conversation for another day, but I really do like the 20-day EMA. I also expected lots of support in the 170 to 175 area, and premium levels were still pretty elevated post-earnings. Now, obviously, Palantir is the poster child of overvaluation, but it's also a terrific company with fantastic growth and high implied volatility levels on the options. And I had no qualms about entering this 3-day trade with a small opening position size, as I felt it would be straightforward and easy to repair if anything went wrong. Well, it didn't go super wrong, but it did go wrong. This is also part of a new put-selling strategy that I just introduced into the Leverage Investing Club that I call Quick Hit Weeklies. Unlike our core sleep-at-night high-yield option income strategy, which initially has a target duration of 3 weeks to 45 days, and which incorporates fundamentals and valuation as well as technicals, Quick Hit Weeklies have much shorter durations, ideally just a few days. And the emphasis is primarily on technicals and high premium levels. So far, we're 3 for 3 on these trades, including this one on Palantir that did require some minor trade repair efforts. So on our entry, it turns out that bounce off the 20-day EMA, and the same thing happened the next day on Wednesday, just wasn't enough. The stock fought hard to hold that level, but on the day after that, Thursday, Palantir really sold off hard. It actually closed the day at $175.05 a share, which means the position was still out of the money, barely, with just 1 day to go until expiration. Now, Friday was interesting. The stock gapped lower a bit, opening at $173.15, but traded as low as $168.91 before staging a comeback and ending the day and expiration at $177.93 a share. So if we'd done nothing because of the late day rally on Friday, the short puts would have expired worthless and the trade would have worked out as planned. But obviously there was no way of knowing that would happen. And earlier in that Friday session, with Palantir trading at $171.04 a share, I rolled my expiring and in the money by about $4 a contract. $175 short put position, down and out 3 weeks to the November 28th expiration cycle for a small 13 cents per contract net credit. I bought to close the November 7th 175 put for $4.95 a contract and sold to open the November 28th $160 put for $5.08 a contract. Quick comment about trade repair. Our number one objective when a short put position trades in the money on us, meaning the stock trades below the strike price of our short puts, is when it comes time to roll or adjust, we want to work that strike price lower while still generating a net credit, meaning we collect more for setting up the new leg than what it costs us to buy back or exit the old leg. And we don't want to roll out more than 3 monthly expiration cycles in the future. Now, the nice thing about working with high implied volatility levels is that it makes that process a lot easier. Now, I did not have to go as far down on the strike price as I did. Could have gone with a higher strike price like 170 or 165, and the position would have been back out of the money again, and I would have collected much more net premium. But I saw a lot more technical support around 160 than I did at 165 or 170. So I was willing to sacrifice some on the returns in exchange for having a much safer trade. This was our first quick hit weekly trade after all, and I didn't want to screw it up. And a $15 reduction of the strike price from 175 to 160 in just 3 weeks was amazing. Actually, I sacrificed a lot in terms of the returns. I didn't give anything back, of course, but that net credit of just 13 cents a contract over the following 21 days worked out to be just 1.31% on an annualized basis. That obviously sank the overall returns of the entire trade. If held until expiration, and assuming Palantir was still trading above 160 a share 3 weeks later, the final returns on the entire trade would work out to be just 8.51% over 24 days. Not the worst outcome in the world, but single-digit annualized returns on any option selling trade is never the goal. And it's usually not the reality either. Case in point, of the 46 official club trades we closed in 2025, all of which were profitable, only 4 generated single-digit annualized returns. The other trades, more than 90% of them, produced double-digit or triple-digit annualized returns. But again, I was being very safe and probably did a little overkill on the strike price reduction. Now here's where it gets really interesting and where I decided to do something I almost never do, which is to roll that 160 short put back up to a higher strike. So the stock continued to rebound off those Friday lows and in fact gapped higher Monday morning and was trading all the way back near $190 a share. Can we say volatility? Obviously that boded well for the short put position, which again was all the way down at the 160 strike, but it was still basically 3 full trading weeks out until expiration. Now, we're usually accustomed to rolling out or down and out, meaning we roll a position out farther in time either at the same strike price or at a lower strike price if we can generate a net credit in the process. Like I'd done the previous Friday, rolling down and out 3 weeks from 175 to 160. But obviously that's not the only way we can roll. We don't actually have to roll out to an expiration cycle farther out in time. So I saw an opportunity here to roll up to the 170 strike price on the same November 28th expiration cycle. And I like this move for a number of reasons. First, I still saw support around that area. It was still $5 lower than my original position, and it recaptured more premium, which would help offset that terrible 13 cents per contract net credit I accepted, working the strike down to 160. So with Palantir trading at 189.17 a share, I rolled my 160 short put position up to the 170 strike for $1.20 per contract net credit. That now brought the projected annualized ROI in the campaign up from the previous mediocre 8.51% over 24 days to a much more respectable 18.83% annualized ROI over those same 24 days. Now, I'm not going to do a day-by-day account of the trade, but as you can see, Mr. Market wasn't done with the head fakes, as Palantir sold off again and much lower than before. And 10 days later, on November 20th, with Palantir trading at $158.07 a share, I rolled that November 28th $170 short put down and out another 3 weeks to the December 19th $165 strike price for a 99 cents per contract net credit. The shares eventually recovered and ended at that December expiration at $193.38 a share. And I did no more fancy rolls or adjustments, but just let the trade drift off to worthless land. Final returns were very solid and respectable, 15.29% annualized over 45 days. Okay, so let's look at the pros and cons of rolling a short put up to a higher strike, because options are always about trade-offs. Pretty much the only advantage of doing so, but it's a good one, is that you set yourself up to collect more net premium and therefore higher potential returns. And that's what happened with my Palantir trade. Even after I experienced additional complications and had to extend the trade once again and work the strike price lower again, I still nearly doubled the final annualized ROI on where the trade had been from 8.51% annualized to the final walkaway returns of 15.29% annualized. Now, the potential downsides? The more you chase a stock higher by rolling your short puts up to higher strike prices, whether we're talking about the same expiration cycle like I did with the Palantir trade, or whether that involves rolling out as well, the more you run the risk of the stock pulling back and your short put position trading in the money. Now you've got repairs and a longer trade on your hands. And that's also what happened with me on the Palantir trade. Although the consequences weren't very severe at all, as I only had to extend the trade another 3 weeks, And the shares did finally rebound enough that I was easily out of the trade with solid enough returns. So the Palantir campaign was interesting because you can see both the pro and con elements impacting the same trade. Now, what I actually think is most useful here is to take things on a case-by-case basis rather than making a blanket statement like you should never roll to a higher strike, which incidentally I rarely do as part of a regular standalone put selling trade. Now, it's a different story if we're talking about an intentional, longer-running campaign where I'm simultaneously selling both calls and puts and doing a lot of adjustments and such. But when I'm trading standalone naked puts for income, it's very simple. Every time I touch the trade, from entry to then roll or adjustment, I want my cost basis or break even to be going lower, not higher. And there are two ways the cost basis / break even goes lower: by collecting net premium and by working the strike price lower, which again, I only do so if I can also snag a net credit. But if I'm rolling to a higher strike price, my cost basis or break even is also going to be moving higher. With my Palantir trade, when I rolled up from the 160 strike all the way up to the 170 strike, my cost basis / break even definitely increased from where it had been at that point. But, and again, this is what informed my reasoning at the time, the new cost basis or break even was significantly lower than what it initially was when I first entered the trade, because that original strike price was at 175, and because I continued to accumulate net premium on all three legs of the trade up to that point. So yeah, I think you have to take things on a case-by-case basis. And that also includes the technicals. If you feel strongly that a stock that's made a move higher won't be giving those gains back this side of expiration or even a future expiration, and you want to trade a little more aggressively, then yeah, rolling up or even out and up can be a valid choice. But for me personally, 99% of the time, I'm probably just going to take the win, exit the trade, and then go out and find a new opportunity I like. Okay, if you enjoyed this and want more, be sure to check out the channel's other videos. I'm actively adding new content again and have a backlog of video ideas I want to share with you. I'm also organizing these videos in various playlist categories, so that should make it easier for you to find the resources that are the most valuable to you. Also, sign up for the Daily Tips newsletter via the pinned comment below. The newsletter is a tremendous option selling insurance company from hell resource and really complements the YouTube channel, as some topics are better suited in article format and some are better suited in video format. Both resources are all about heads you win, tails Mr. Market loses. So if you're interested in learning how to find great new trade ideas every week and consistently turn losing trades into winning trades, the newsletter is a resource you're going to want. Again, you can sign up directly, or there's also a link in the description section below to the Great Option Trading Strategies downloadable library page. Download anything from there, and you'll also begin receiving the Daily Tips newsletter automatically. Heads we win, tails Mr. Market loses. That means you should be coming out ahead on virtually all of your trades. Okay, until next time.